Hello, I hope this finds you well. Today is Monday, October 19th, 2015, and in about 5 minutes, I will share with you more about what happened in the markets and the economy last month, as well as last quarter, and our outlook moving forward. So the end of September marked the end of the third quarter, and nearly every asset class across the board declined. The reason that almost all asset classes declined was because of continued global growth concerns, especially out of China, uncertainty about the future path of the Fed and its policies, and lastly, weak earnings expectations, which are being pulled down by the energy sector as well as the strong dollar. So all of these concerns ultimately led to increased volatility in global risk assets. The S&P 500 was down 6% for the 3 months leading up to September 30th, but was the best performing equity market if you compare it to international markets. The Developed International Markets Index, as measured by the MSCI EAFE Index, as well as the Emerging Markets Index, as measured by the MSCI EM Index, were down 10% and 18% respectively. Small cap companies here in the US struggled more than the broader market, down 12%. Commodities also faced continuing downward pressure, falling 14% in the wake of weaker Chinese data. Within the fixed income space, interest rates fell across the maturity spectrum in September, with the 10-year Treasury yield falling from 2.21% to 2.06%, and the yield curve flattened slightly, which means that long-term rates came down a little bit. The high-yield bond index fell 4% as spreads continued to widen in response primarily to lower energy prices and slowing global growth. The one standout in the bond market was the Barclays Aggregate Bond Index, which rose 1% after the Fed failed to raise rates in its September meeting. We received mixed economic data in September. However, one important indicator I talk about a lot, the Conference Board's Leading Economic Indicator Index, or LEI, increased a solid 4.1% in August, which has historically been associated with only a 4% chance of recession in the next 12 months. So that still looks really strong. So after a long bull market in stocks, a key concern and question that I get from a lot of investors is this market overvalued, right? Is it expensive? And so the chart I want to share with you this month from JP Morgan's Guide to the Markets shows various valuation metrics for the S&P 500. So let's take a look. The chart shows the forward PE for the S&P 500 over the past 25 years. That is the price of the S&P 500 divided by the annual earnings expected at the time by analysts for the following 4 quarters. There's also a box showing other valuation metrics. Overall, the chart shows the market is now a little bit cheaper than average, with the forward PE ratio at 15.1 times compared to the long-term average of 15.8 times. But market valuations should really be viewed in relative terms. As shown in the box, the earnings yield of stocks is still significantly higher than the yield on BAA bonds, which are still being depressed by very low inflation and low short-term interest rates. The key takeaway here for me is after the sell-off in the third quarter, stock market valuations now look somewhat cheap in absolute terms, but significantly cheap relative to bonds. Looking at the rest of the year, we remain confident that stocks will rally and we have a good chance of ending in positive territory, driven primarily by easing China fears, increased comfort with the Fed's go-slow approach, a likely solid earnings ramp-up over the next several quarters, stability in the energy sector, and favorable seasonal patterns. But we can also continue to expect volatility. So I want to remind you that in these challenging environments is when investors most need to maintain composure and stay invested with a diversified portfolio. I'd like to thank you for taking the time to watch this. I hope it was helpful, and if you have any questions, please feel free to give me a call. Take care.